US stocks and the US dollar rally on hopes Donald Trump will cut tariffs on China, and his comments that he doesn't want to fire US Federal Reserve Chair Jerome Powell. But business surveys out overnight in the United States and Europe show activity has already softened. That's coming up in our 5 Things in 5 Minutes on Thursday, April the 24th. And then in our bonus deep dive interview, ANZ economist Vicky Xiao analyses detail on the goods trade between the United States and China to explain why Trump may have been easing his tariff rhetoric in recent days.
This analysis really kind of give extra evidence that the US tariff on China is not going to be the solution for the higher trade deficit with China. And in contrast, it might have the opposite effect.
But first, in 5 and 5 with ANZ, the S&P 500 is up 2.2%, the Nasdaq is up 3.3%, and the dollar has rallied 1% by 4 a.m. Sydney-Melbourne time, after comments from Trump and others in his administration that he wants to lower tariffs on China, possibly down to 50 to 65% from 145%, although that's without detail or confirmation. And after Trump said he had no intention of removing Federal Reserve Chair Jerome Powell, here's ANZ's head of G3 Economics, Brian Martin.
Markets regarded both as favourable in that they would help to reduce uncertainty, certainly help put a floor on the deteriorating growth expectations, and also help to stabilise what has been recent concern that the stability of the Federal Reserve may be at risk, something which could contribute to higher inflation and higher inflation expectations.
As of 4 a.m. Sydney-Melbourne time, the Aussie dollar was flat at 63.71 US cents, as was the Kiwi at 59.61 US cents. With all the risk being put back on the table, the safe haven trade of gold fell 3.6%, that's $122 an ounce, to $3,296 an ounce. Number 2, Purchasing Manager Survey results, the PMIs, were out overnight for the United States and Europe, confirming a sharp downturn in sentiment, orders, hiring and investment since Donald Trump's Liberation Day tariff shock on April the 2nd. Here's Brian again.
In the US and in Europe, the weakness was principally led by softness in service sector activity. In fact, in the US, service sector activity fell to its lowest level in 16 months, and also the lowest level since President Trump has been elected. So there are concerns that the uncertainty being created by tariffs is not just affecting the manufacturing sector, but the broader economy.
Number 3, against expectations that consumer and business confidence around the world would be hit, ANZ's Roy Morgan Consumer Confidence Survey in Australia actually rose in the last week by 1.3 points to 85.5. ANZ economist Sophia Angala says while global uncertainty is feeding through in the survey, it is being offset.
It does appear that the upward pressure on consumer confidence from improving household incomes, from those stage 3 tax cuts introduced in July last year, cost of living relief, and rate cuts flowing through to households, it is being offset by increasing risk in global economic activity from ongoing tariff announcements. Looking to also weekly inflation expectations that did see a rise to 4.9% last week as well. So it does appear that global trade uncertainty is continuing to impact household confidence.
Number 4, Bank Indonesia held its key interest rate at 5.75% yesterday. As expected, ANZ economist Crystal Tan says currency stability is the main focus for the central bank, with the rupiah underperforming compared to other currencies in the region.
Bank Indonesia did retain an easing bias. It reiterated that it remains on the lookout for room to cut rates. So easing is going to depend on the rupiah trajectory and also inflation and growth prospects. So we think rate cuts are a matter of time. We see scope for 3 25 basis point rate cuts this year as BI strikes a balance between growth and external pressure.
Number 5, inflation data in Malaysia and Singapore were both lower than expected yesterday, setting up central banks in both countries for monetary policy easings in the coming months. Malaysian inflation came in lower than expected at 1.4% in the year to March, at the same time as the growth outlook is being downgraded because of all this tariff uncertainty. ANZ economist Arindam Chakraborty says ANZ research now forecasts a 25 basis point cut by Bank Negara Malaysia in the second half of 2025. Meanwhile, ANZ's head of Asia Research, Koon Goh, points to a fall in Singapore's core inflation rate to 0.5% from 0.6%, thanks to falling retail goods prices because of a strong Singaporean dollar. Here's Koon on how the Monetary Authority of Singapore, the MAS, is likely to view this data.
Overall, with inflation under control and set to be well below the long-term average levels, the MAS will be focused on growth. And following the April easing. If there is further deterioration in the economic outlook, we can expect the MES to further ease policy to neutral at the upcoming July MPS.
Couldn't go there. Now, in our bonus deep dive interview, ANZ economist Vicky Xiao has been comparing the complexity of China's exports to and imports from the United States in recent years. She talks to my colleague, Alex Tarrant.
So with US and China imposed more than 100% tariff to each other's products, any further escalation on tariff lacks meaningful impact. A tariff exceeding 100% does not necessarily mean 100% drop in trade for both China and the US. The bridge in between is the price elasticity of the products US and China sell to each other. So in this research, we constructed the product complexity index for China's export to the US and also the US export to China. We found that the complexity score for Chinese goods to the US doubled from 2000 to 2024, while the US products to China dropped significantly. On the product level, we can see that the top Chinese products exported to the US are smartphones, batteries, and data processing machines, while the top US exports to China are mainly in the agricultural and the natural resource categories. The increase in the sophistication of China's export mix implies higher price inelasticity, meaning China's exports are less sensitive to tariff hikes. In contrast, China's import from the US are relatively easy to replace. As a result, while China's export to the US are expected to fall, the faster decline in China's import from the US could lead to a wider trade balance on the goods side.
And so I guess that's a surprising finding for people who have just been looking at the headlines, because I think the intention of the US administration is for the opposite. So just talk us through how that trade balance may go the other way to what's expected.
So on the good front, because China can easily reply US import from other countries, but China's export to the US are not easily to be replaced. So the faster declining pace on the China's import from the US front could surpass the pace that China's export to the US. So this unparalleled decreasing pace could lead to the wider trade balance between China and the US on the goods front. On the service front, China currently runs a service deficit with US at $31.8 billion US dollar. This is about 11% of US goods deficit with China. With China issue travel and study alert to its citizens going to the US, we could see a fast decline in the size of both cohort from China. Also, we are likely to see more restrictions on the trade front, on the commercial front, such as Hollywood movie are restricted in China and more antitrust probes into US multinational companies. So on the service front, we are likely to see the shrink of service deficit with the US from China.
So what does this mean if we take this analysis and sort of apply it to the next steps in this trade dispute? What could it mean in terms of how each country approaches the next steps, do you think?
I think this analysis really kind of give extra evidence that the US tariff on China is not going to be the solution for the higher trade deficit with China. And in contrast, it might have the opposite effect that in the short term, in the near term, we are going to see US deficit with China increase. I believe the current US administration already realized this problem. Yesterday, we've seen US Treasury Secretary Scott Bessent came out saying China and the US need to de-escalate this trade war. And on the China front, China also signaled the willingness to talk if US show respect. So we'll continue to see the possibility of this tension to ease in the near future.
Vicky Xiao there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, April the 24th. We'll be back on Monday, April the 28th, after Anzac Day, tomorrow in Australia and New Zealand. It's a public holiday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.